again, I don't want to over embellish the idea, but when people have fear on what's happening to their retirement, the 401k, the Social Security system, whatever, maybe in the future, again, I'm trying to stay level-headed, but I'm also realistic. And the realism is, look at the history to see how bad things can get at times. Doesn't mean the end of the world, doesn't mean mass starvation across the planet, but it's hard times, and it's a readjustment, and it's uncomfortable, and it's a reevaluation. Okay, well, the first thing is, where are we headed next? The answer is still higher. Well, we are definitely in what I would consider to be price discovery mode right now, which, so many of us have written about, talked about, lectured about for decades, really. I mean, if you look at the late, great Ted Butler and all his work, primarily focused on the paper markets, which really set the price until they don't, which is where we've been for a few months. And, Ed Steer, who's still with us and basically worked with Ted for a very long time and continues his excellent work. And so we're in a situation where all those things you mentioned are pushing both the metals higher. Geopolitical uncertainty, currency crises in the background, war escalations, everything you would not want as far as societal ideas are concerned, but as far as a bullish setup for precious metals is already in the mix. And when I wrote that article on LinkedIn, it's the easiest place really to write an article. When I do that, I usually put it on my Substack and I put it on the X as well, because once you write on the LinkedIn platform, it gives you a quick link. You just press the mouse and it will post the link to it on X. But anyway, coming back, it's been a heck of a ride so far. We're going higher. How much higher, I don't know. But there's been a lot of disinformation. And in the earlier days, and I've got a few years on me, when I started to see a lot of speculative penny junior stocks in the silver and gold space come on board on the pink sheets, that would be the sign of froth in the market. And now that things have changed so much with the internet, you're not seeing very much of that at all. What you're seeing is these AI generated bots doing very convincing pitches about gold, silver particularly, with, I'd say, about an 80-20 ratio, about 80% truth that most people understand, basics that are accurate, mixed in with just indiscriminate, fluffy nonsense. And so I'll give it back to you, but I felt it was important to alert the community that, the old adage, don't believe everything you hear, and even don't believe everything you see. I mean, our eyes can deceive us at times as well.
As interest in gold and silver surges, so does misinformation, much of it powered by artificial intelligence. Online platforms are flooded with polished videos and confident voices blending accurate fundamentals with fabricated claims. These narratives often sound authoritative, citing obscure rules, unnamed insiders, or leaked documents. The danger lies not in obvious falsehoods, but in subtle distortions embedded within otherwise credible analysis. In fast-moving markets, investors are especially vulnerable to persuasive storytelling. The old warning, "Don't believe everything you hear," now extends to what you see and share. Separating signal from noise has become a critical investment skill.
Yeah, well, Dunnigan, absolutely. This is a timely and very important topic. And the volume of AI-generated silver intelligence is exploding, with much of it ranging from very sloppy to outright fabricated. And yet some of them are structured in a way that sounds very good, as you outlined. So it's my job and others to vet it, filter it, and expose the nonsense, both for ourselves to make rational decisions based on as much fact as possible, and also for your audience, my audience, and the general public. So I wrote that article with that in mind. And so let's just look at a couple things that are kind of red flags if you think about it. Because when you get a precise rule number 175.21 subparagraph A. I'm just making that up, but that one that I talked about on LinkedIn had something along those lines. And actually that rule did exist. I looked it up, but it had nothing to do with what the bot said it had to do with. But most people wouldn't even know where to find it or wouldn't take the time to find it or what website to go to. And, you get a bunch of stuff and then you get that one extra thing that sounds so convincing and so good. Oh my goodness, that rule's in effect now? Holy moly, I gotta buy silver. And it was a fabrication. Again, the site of that number was correct. And it had absolutely nothing to do with what was stated in that video. So I think some of the red flags are pretty simple, common sense. One is an internal memo. Well, an internal memo. Okay, great. How does this guy get an internal memo? Well, if you had one, you document it. Show me the document. Show me in PDF. Even if you make it up, I'd like to see it. At least I could, have a look at it. Of course, that would be fraud. And, if you put Monsanto's, let's say Samsung, that's a name we hear a lot in the silver space right now. Let's say you had Samsung letterhead and put out the memo and said that's the document. Well, now he's frauding people. And so we're going to be like, he's in big trouble, finding him and all that. That's a different story. So he's not going to do that. I mean, I think who's ever behind it is smart enough to know that. So if you get an internal memo and no documentation, think about it. And then when you get an anonymous banker said, anonymous banker, well, who's that? Well, again, how do you determine that? So these are very, common sense when you take them, just two words, right? Anonymous banker. But when you're listening to this thing for 15 minutes and you're kind of dug in and, 90% of it's learning the stuff to be factual. And then an anonymous banker, and then all of a sudden after the anonymous banker, which he kind of goes through you, says that JP Morgan is in a situation where they have covered all their short positions and they've gone long metals at the tune of 450 zillion ounces. It's like, oh, wow. Because they know the name JP Morgan and it was just an anonymous banker that said it. So, hey, why wouldn't I believe that, right? So you got to break it down, right? So another one is a whistleblower claims. What whistleblower? If you had a whistleblower that got a hold of you, I'm going to do some conjecture here, push back, say, David, you're completely wrong. But I would guess that if you had a whistleblower call you and say, hey, blah, 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 silver, you'd probably call me on the QT and say, hey, David, I got this guy named so-and-so, the Clemsies at the trading desk at in the LBMA, and he's claiming blah, 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 blah. Do you know him? Could you vet it? Could you find out for me? I think he'd probably do something like that. It might not be with me. It might be with another one of your contacts, but I don't think you take it at face value on hearsay that such and such guy called you up, claimed to be a whistleblower, and all of a sudden you're going to make a Liberty and Finance video about it, right?
There are clear warning signs that a claim may be unreliable. Vague references to anonymous bankers, undocumented internal memos, unverifiable whistleblowers, or alleged leaks without primary sources should immediately raise suspicion. Real market-changing information leaves footprints. Regulatory filings, official exchange statements, central bank releases, or audited reports. Extraordinary claims require traceable evidence. When facts are genuine, they can be independently confirmed and cross-checked. Responsible analysis relies on collaboration, verification, and transparency, not secrecy. In a market already fueled by emotion, resisting sensationalism protects investors from costly mistakes driven by hype rather than reality.
So another one that's kind of a clue that this is probably not on the up and up is another one used often is leaked from a major institution. So let me reiterate on those. So internal memo with no documentation, anonymous banker said, whistleblower claims, and leaked from a major institution. All those are big, big red flags. Now let's go on the flip side and say those things are real. How would those be presented? Be presented to trace it to a regulatory filing from the SEC, the CFTC, Bank of International Settlements, the OCC, the LBMA, you name it. So LBMA came out with this news. It's on their website. David Morgan or this other guy, this AI showed it to you. I mean, facts are facts, no matter where they come from. You dig them out first. You're first on the story. Let's say, hey, the LBMA just announced that, and here it is right off their website. So that would give you a lot of credibility because you're showing people the website. So you really want to see something in a document if it's claimed to be in a document. And then you want to be able to see it in the public domain if at all possible. And then you want to find collaboration. I mean, if, I find it first as an example. Let's say you find it first. And then you send it to me. Can you verify this? It looks right. I got it off the BIS website. And, I find out from my webmaster that that's a phony BIS website. It's not .org. It's not whatever. And let you, I don't know. Or determine, yeah, that looks legit. Well, then, I might get a hold of Mike Hall or, somebody else. Say, you know what? Dunnigan just showed me this. I can't find any holes, but I don't want to be wrong. I want to get your eyes on it. Will you help me out? Take a look at this. So I get collaboration on something that was, let's say, one-off, a little bit out there as far as related to the economy, silver, the currency markets, what have you, bond market, whatever it might be, had determined the best of our ability that it wasn't a fictional piece, it was real. And so there's that. And then there's, how many millions of ounces are delivered. I mean, this one drives me absolutely nuts because there's so much, even in the community, of people that are pretty sharp, really don't get the amount of silver being delivered in and out of the exchange. I mean, best of the best is probably Ed Steer. Ed's better than me somewhat because he looks at it more often than me. But there's so much that goes on in this first notice day that people don't understand. The reason that I do is I've studied it for so many years, plus I traded futures. I mean, I got caught one time where I went past the final day where you had to put up or shut up. And I mean, I got kind of panicked. I was in my 20s. I didn't have the cash. I'm, oh my God. And I called my broker and he just kind of laughed at me, not, to be funny, but to say, relax. These things are not, they're in setting up concrete. There's almost always a way out. And so he told me what to do. I forget the exact verbatim word for word, but basically I relaxed. Even though I was past the final date, we made amends, paid a fee or whatever it was, and life goes on. So not that they're not important. I mean, I don't want to sound like I'm talking out both sides of my mouth, Deligan, but it's a different thing to say there's 412, million ounces being delivered next month when it's 1/10 that amount, to get people very excited and to be able to determine, the actual facts of what happens. And the other one, of course, is interbank movement of metal, where it goes from UBS to HSBC to JPM to whomever. A lot of that's kind of just shuffling the deck within the house. And that's happened a lot. But lately, there's been more offtake out of the exchanges. There's no doubt about that. But you don't have to exaggerate. The story is so good. And I presented it. Michael Oliver has presented it. So many of us have. I mean, Mike Maloney. I mean, I don't want to leave anyone out. We'll probably take the rest of the show to talk about everyone's talk about gold and silver in particular and how great the fundamentals are and how the technicals. But you don't have to exaggerate anything, and that's what kind of annoys me is that whatever the motivation is behind these bots, I don't really know. I just want to interject one thing real quickly before I forget. I woke up this morning, my usual very early in the AM, and my webmaster said, look what I found. And it gave me the URL, and it's the Daily Silver Report by David Morgan. And it's got my image and my voice, and it's all AI, and I didn't have anything to do with it. And there's like 30 of them already made up. So there you go.
Despite the noise, the broader signals remain clear. Fiat currencies historically lose purchasing power, and today's debt-driven system shows familiar stress patterns. Weak demand for long-term government bonds, rising refinancing risks, and persistent deficits point to declining confidence in sovereign credit. Precious metals act as a pressure gauge, reflecting these imbalances well before they dominate headlines. Gold and silver are not forecasting prosperity. They are signaling instability. As interest rates, inflation, and monetary policy collide, metals respond by repricing higher, not out of speculation, but as protection against systemic uncertainty.
Well, I think for the big picture has gotten stronger. I mean, we've known each other for decades, as you mentioned. And the fundamental story, as I've said so many times, all fiat fails. And unfortunately, the US dollar is no exception. Whether it'll go to zero or go the way of the Weimar Republic or the Zimbabwe dollar, I really doubt. But nonetheless, the metals are giving us a barometric pressure. They're forecasting in the future that things are not going to get better. And we see that by the lack of interest in the U.S. debt markets, the treasury markets. Across the board, really. I mean, from near-term treasury bills, there's still an appetite for those and they're safest. But you start going into T-notes and T-bonds, there's less and less interest in the United States debt market. So that's a big red flag. The bond market's everything. Everything's based on credit. And because of that fact, if we cannot sell our debt to whomever, nation states, pension funds, insurance companies, et cetera, without having the price bid up, meaning the interest rates going higher to take on the added risk of what they'll be worth in the future, even though the administration wants to make sure that interest rates go down, we're at a conundrum where basically if we keep pushing interest rates down, I think it'll add more fuel to the fire for the price of gold and silver. So to get more specific, I mean, I said in 2003, I thought we'd see $100 silver. I think that's almost inevitable. If you look at $5,000 gold, which is conservative at this point, that ratio of 50-1 puts, $5,000 gold, 50-1 ratio is $100 silver. I think those are achievable this year. In fact, probably in the first quarter. That's how fast this is moving. The other part is what happens on the geopolitical side. And that is an area I study. I'm not the best at that. I mean, if you're going to really look at that, I know you have them on the show from time to time. Let's say, Marty Armstrong's probably, got a better handle on that than I do, although I pay attention to it. But these are very massive shifts in the global economy that we really have to pay attention to, because just because our oil is sitting in Venezuela, we're going to go get it. I mean, these are things that are very upsetting to, anyone that understands what really is taking place in today's world. I think gold and silver have got further to go. Platinum has been kind of late to the party. I luckily wrote about it about 6 months fundamentally in the Morgan Report and pulled the trigger almost perfectly. Don't always get it that accurately, but this time we did. So we pulled the trigger on platinum at about the $1,000 ounce mark, and it's more than doubled now. I think platinum is one that you only take on if you're pretty high net worth and you already have enough gold and silver. But platinum's a unique story because it's been in a deficit for quite some time. And depending upon the future, which no one knows, if we start moving more toward a hydrogen economy, that would definitely take in more platinum than we currently use just in the automotive sector. And a little more in jewelry, but just a little more in jewelry. So I'm bullish on all of them. The reason I still like platinum, even without those two caveats I gave you, is the scarcity of the metal that we're seeing through Asia. So here's an example. Someone calls up you guys, I forget the phone number, I give it out, you can say it at the end, and they want to buy metals through, let's say, Miles Franklin, and you say, wait a minute, there's a 6-week hold on silver, there's a 3-week hold on gold. Well, what else you got? Well, we've got platinum ready for delivery. I want it. I mean, people start to panic at some point, or they could. Not trying to put the panic button. I'm not trying to push the panic button. All I'm saying is that near the end, you want anything that you think is a safe haven, and there's not a better safe haven than physical metal, which obviously top tier is gold, second place is silver, third place is platinum, maybe fourth place is palladium, and hey, you might say fifth place is copper. I mean, there are people that stack copper, I should say. So again, I don't want to over embellish the idea, but when people have fear on what's happening to their retirement, the 401k, the Social Security system, whatever, maybe in the future, again, I'm trying to stay level-headed, but I'm also realistic. And the realism is look at the history to see how bad things can get at times. Doesn't mean the end of the world, doesn't mean mass starvation across the planet, but it's hard times and it's a readjustment and it's uncomfortable and it's a reevaluation of value. And that's what happens in a currency crisis is we have to revalue what's worth what. And of course, what's really important is food and energy. So those could cost more in real terms, in gold terms. Whereas housing might come down because it's based on credit and the credit cycle breaks. And so either you pay up or shut up. Well, wait a minute, I have to sell my house for cash and I need it. And on a mortgage, it would be worth X, but for a cash market only, it might be 0.7X. I just took a 30% discount on my house, but I'm willing to do it because I got to get out of here or whatever. Again, I'm sounding doom and gloomy. I don't mean to be. I'm trying to paint an accurate picture. I'll give it back to you. You might be able to maybe muffle that slightly, but I mean, I'm trying to tell people, as I've said so many times, 90% of the move comes in the last 10% of the time, and we're there. And that doesn't mean it's going to peak a week from Tuesday. But if you're not in now, I think you should get something. Doesn't mean load up everything, sell your real estate portfolio, put it all on the goal. I'm not saying that, but I'm saying I think you need some exposure. So let me get your feedback on what I just said.
While gold and silver remain the foundation, other metals have begun to attract attention. Platinum, long overlooked, faces supply constraints and potential future demand from industrial and energy transitions. Its market is smaller, thinner, and more volatile, making it suitable primarily for experienced or well-capitalized investors. Meanwhile, mining equities often lag the metals themselves early in bull markets, as earnings take time to reflect higher prices. Eventually, strong producers generate significant cash flow, forcing equity markets to respond. Selectivity matters. Quality, balance sheets, and jurisdiction outweigh speculation.
Now, that's where the real value is now, and it's typical in a strong bull market that the precious metals mining shares, and mining shares in general, in other words, lithium or copper or cobalt or whatever, lag the metals themselves. And it's based on a couple things. The equity mindset is different than the commodity mindset, although some people do both, obviously. Basically, the stock market is based on earnings. And so the earnings haven't hit the bottom line for the last quarter's earnings, for example, for these mining companies. And once they do, Wall Street will have to pay attention that some of these majors are actually value plays. They're really spitting off a lot of free cash flow. So that's an area. I just got off the phone with a new member and I go through, how the mortgage report works, what to look at right now, what's more important than something else. And I showed him one of the top tiers that I suggested you put big money in, not a junior that's going to make you 100 times your investment. This is one you can put in substantial funds in, and it's up 30-fold. Well, 30-fold on a $5 silver is $150 silver. And as good as silver's doing today at about 80-something, that investment in a streaming company has done almost twice as good as that. And the other thing to think about is, how these things are taxed. I mean, unfortunately, and the Silver Institute and others have been on the bandwagon to get the capital gains tax changed on gold and silver as collectibles, because a bullion coin is not a collectible coin, but a rare gold coin is a collectible. Why is all gold treated as a collectible on the tax basis? It's just plain wrong, but it is. And it's a higher tax rate than this company I'm talking about that's basis on a long-term capital gain. So not only did it outperform the metal itself by almost 200%, the tax rate's lower. So your net in your pocket is better. And I know there's people that are, don't do mining shares. They're not as good as the metal. Well, it depends on what mining shares we're talking about. And if you factor in the tax consequences, I think you need both. I mean, look, I'm selling the book for Miles Franklin. I think everyone should start with the real metal first. I've said that from day one, and I'll continue to say it. But if you already have metal, or even if you don't, but if you want to look for where the best place to put new money, it would be in the mining sector. I have one that I just did an interview with for our members last Friday. It's been out for the group for a day or two. I'm going to let it cook for about 2 weeks. And then I think I'll do a clip out of it for the general public on probably X or whatever, just to show them, how we analyze things. And this company's basically selling at zero. What do you mean, David? The amount of cash or cash equivalents the company has is equal to the market cap. So it's like I have a deposit, a really good one, that's been explored and had a JV with a major company at one time. They fell off. All of that's sitting there owned by us as a shareholder, yet all of the cash side, all the stock we own in up and coming companies and cash equivalent is equal to the market cap of the company. So you're getting all the mining upside for free. That's a very low risk situation. And my people have it right now. They're holding it and probably buying more. I'm buying more. I'm going to not front run them. I'm going to wait another 2 days before I buy more. So anyway, and those opportunities aren't all over the place, but I don't want to belabor it. But I think you need both personally. But it's not for everybody. I understand. There's people that say, hey, I want metals only. I don't trust the stock market. I don't trust anything on paper. That's fine. I'm not going to turn them around and say you're wrong or that's a fair assessment. As far as I'm concerned, if I didn't have that one underlying company I told you about, there have been times I had to dip in there to keep things going. It's not that way anymore, $80 silver, but there were times where, let's say, things weren't exactly moving my direction. And it was, about a 10-year time frame. I'm not saying I was poor or broke or anything, but, we were just kind of breaking even, treading water. And you might have been the same way for a while. I don't know. But it wasn't the easiest game in town there from the peak of 2011 until we really started to pick up when silver broke the $35 level.
Late-stage bull markets are deceptive. Most of the price movement typically occurs in a short window, often after years of patience. That does not mean reckless action, but it does argue for thoughtful exposure. Physical metals remain the ultimate insurance against financial instability. Mining equities can enhance returns when chosen carefully. The goal is balance, not extremism. History shows that periods of monetary reset bring discomfort, repricing, and opportunity. Preparing early allows flexibility. Waiting for perfect clarity usually means arriving too late. In uncertain times, measured action is often safer than inaction.